Right now, on Sunday the 9th of August, 2026, the euro to dollar pair is coiled at one of its most consequential technical barriers in weeks, the 100-day simple moving average at exactly 1.15686. This level has acted like a magnet, drawing buyers in, yet refusing to let price close above it. Every attempt over the past 3 days has been met with selling pressure, and that sets up the single biggest question for Forex traders this week. Will euro to US dollar finally smash through and race towards 1.1700? Or is this the setup for a brutal rejection that sends it tumbling back below 1.15? The stakes are unusually high because this moving average coincides with a 7-week high in the pair, driven by genuine dollar weakness, not just euro strength. We are not guessing here. Live research from MyTrade, FXStreet, and TMGM all confirm that buyers are loading up at every dip, while the 100-day SMA remains the last stubborn hurdle before a much larger rally. To understand why euro bulls are so confident, you have to look at what has just happened to the US dollar. The latest US payrolls data, released on Friday the 7th of August, came in weak, and that single data point changed the narrative. Weaker employment numbers mean the Federal Reserve is less likely to stay aggressive on rates, which makes the dollar less attractive. Commerzbank, one of Europe's largest lenders, explicitly warned that US payrolls could cap dollar gains, and that is exactly what played out. The result is a dollar that cannot sustain any bounce, while the euro holds above the 50-day SMA near 1.1490. In plain terms, the fundamental backdrop is giving technical buyers cover to press higher, but that fundamental driver also has a shelf life. If upcoming data surprises to the upside, the entire rally could reverse in hours. On the surface, the technical picture looks firmly bullish. The daily chart relative strength index, or RSI, and the moving average convergence divergence indicator, MACD, both show buyers retain the upper hand, as flagged across multiple research reports this week. Price is defending every small dip, and the pair rose toward its 100-day SMA with momentum turning positive. However, here's where the analysis gets nuanced. One piece of live research from a 4-hour chart perspective warns that the 20-period SMA is still above current price, indicating a bearish tilt in the shorter term. This is the classic conflict: longer timeframe bulls versus shorter timeframe sellers. If the 4-hour sellers overwhelm the daily buyers right at the 1.15686 barrier, we could see a fast slide to the next support zone at 1.0920. That contrast is exactly why this level is a real battleground, not just another number on a chart. If buyers do manage a clean daily close above 1.15686, the path higher opens rapidly. Analysts at multiple firms, cited in our search results, see 1.1600 as the immediate psychological hurdle, but then the real target is the 1.1650 to 1.1700 region. That is not a random guess. It is based on previous resistance clusters and measured move projections from the recent consolidation. The fact that buyers are loading for 1.1590, as one report put it, tells you the market is already positioned for the breakout, not waiting for confirmation. This kind of pre-positioning can create a self-fulfilling surge if the level cracks, especially when liquidity is thin, like a Sunday evening open. But that same pre-positioning also creates a crowded trade. If the breakout fails, the unwind will be swift and painful. So where does that leave us on Sunday the 9th of August, 2026? The immediate levels are crystal clear. Above, a break past 1.15686 and then 1.1600 starts the journey to 1.1650 and ultimately 1.1700. Below, a failure at the 100-day SMA brings 1.1490 into play, with 1.0920 acting as the deeper line in the sand. The conflict between the daily bullish signals and the 4-hour bearish warning means this is not a simple buy and hold. It is a moment that requires watching the price action at the open, not just the narratives. The wider environment is also shifting. Hedge funds, according to JP Morgan data this week, had their 2026 gains dented by tech trades in July, which could affect risk appetite and dollar flows. Every piece matters. To wrap this up in clear terms, euro to US dollar is in a pressure cooker. The fundamental wins from weak US payrolls favor the bulls, and the daily momentum indicators confirm that strength. But the 100-day SMA at 1.15686 has not yet been broken, and the shorter-term chart is waving a yellow flag. My reading of the aggregated research is that a break above is more likely than not, simply because the dollar's weakness is fresh and the dip buying pattern is persistent. Yet any trader who ignores the rejection scenario is taking unnecessary risk. Watch the first 4 hours of the new trading week. If price holds above 1.1550, the bulls have the edge. If it fails and slices below 1.1490, the entire bullish thesis unravels. That is the kind of clarity you need, not a vague forecast. I will update you as soon as the market moves. For now, keep those two numbers on your screen, 1.15686 above, 1.1490 below.